is the Investor Connect podcast program. This is Hall T. Martin. I'm the host of the show, in which we interview angel investors, venture capital, private equity, family offices, and many other investor groups for startups and growth companies. I hope you enjoyed this episode. Thank you for joining us. Well, hello, this is Hall Martin with Investor Connect. Today we're here with John Kim, who is Managing Director at Aphelion Capital, a healthcare-focused venture capital firm based in Mill Valley, California, investing in early and mid-stage medical device and digital health companies. What makes John's perspective especially compelling is the range of experience he brings to the table. He trained in internal medicine at Stanford, studied biochemistry at Harvard, and earned both his MD and MBA at Duke. He sits at the intersection of clinical care, healthcare innovation, and investment strategy, which gives him a unique lens on where healthcare is headed and how great companies are built in this space. John, thank you for joining us.
Thank you, Hall.
So where are you calling from today?
So this is actually a complicated story. So we used to have an office. Aphelion used to have an office out in Sausalito, San Francisco. And we were there for about a decade, and then COVID hit. So we were in the office maybe a couple of times during COVID. And so we decided to do all remote. And because we're all remote, we're kind of disbanded to different parts of the country. Ned, who's the founding partner, moved to Colorado to be closer to his daughter. I moved to Washington, where there's no state taxes. We still have a couple partners out in San Francisco, and we have another couple partners out in Boston as well. So we're situated all across the U.S. These Zoom meetings have made it very efficient to meet companies all over the U.S. and across the world. They don't have to come to your office to kind of pitch your devices or technologies. And it allows us to kind of work from home, but still be in touch with all of our members and admin, and it's very efficient to see companies kind of geographically located throughout the U.S.
Oh, that's great. So tell us more about your investment thesis behind Aphelion Capital and how it evolved over time.
We started off as an evergreen fund, just medical devices. We used to be a 50-50 public-private enterprise where, again, but just medical devices. Over the years, we've kind of gravitated towards cardiovascular opportunities. And then over the past 6 years, we got in touch with the American Heart Association, and they liked kind of what we were doing and decided to form a fund that does mostly cardiovascular brain health opportunities. And that's mission aligned with the American Heart Association. And along came a couple of other additional strategics and fund of funds, and we created a fund just for cardiovascular opportunities. We do also do a little bit of home health as well on a smaller fund, but again, mostly devices, health IT, health tech, med tech, but again, mostly in the cardiovascular and the brain space. And again, this is in the area more recently where we've been seeing a lot more exits occurring and with, much larger market opportunities.
Great. So what key sectors or technologies is Aphelion most focused on today, and why those?
Yeah, so we've avoided their kind of, biologics, therapeutics, pharmas. We didn't have, not to say we couldn't bring in the expertise, but we found the medical devices much more palatable, much more interesting. Personally love seeing commercial stage companies with their devices and being able to bring some of the technologies into the hospital where I still work as an internal medicine, as a hospitalist once in a while at a hospital down in San Jose and one up here near Portland. And I get to bring these technologies, and my nurses and staff, they get to hem and haw and critique it, whether or not it's going to work. And they provide some really quick and easy feedback on some of these technologies, which again helps us to do the due diligence and assess whether or not some of these technologies will actually work, and the providers or colleagues or nurses will really enjoy or find some of the technologies improving their life in the hospital. So again, we, like I said before, we mainly right now focus upon cardiovascular and brain health technologies to kind of meet a lot of the mission statements and requirements of the American Heart Association. And again, we find a lot of opportunities, possibly too many opportunities in the sectors. Love to kind of see come out of clinicals and to get out in the real world and making an impact on patients' lives.
Well, so how do you evaluate the early stage versus the growth stage opportunities? What do you look for there?
Personally, I mean, all of our partners have comes in with like different insights or different perspectives. For early stage and growth stage opportunities, I like working backwards. I like making sure that there is a pathway or already a path to reimbursement, because that's always the longest and the hardest thing to get these days. And then assess whether or not it's going to work in the clinic. Do the physicians have significant need, or our nursing staff have significant need for a product or technology? And then, what is the clinical pathway to get there? Is it easy? Is it hard? Is it going to take significant amount of capital and to raise and to get through to the finish line? And then is the team seasoned? Do they have what it takes to get it out there? Have they experienced some of the ups and downs and understand the difficulties of getting these products to the finish line? But again, there's a lot of things that we miss, things that we've never intended to run through, that you find occurs or happens when you actually dive into the company and invest into them and understand the relationships and the dynamics of the team and the product and the customers. But again, if you can try to knock off a lot of these things that you can kind of plan for, and if the pathways are present already, especially like for instance reimbursement, it makes the process a lot easier to get them into commercial stage, getting customers, getting revenue, getting to growth stage, and hopefully eventually into an exit.
Well, you work with a lot of entrepreneurs. What differentiates the top performing founders in your portfolio from the rest?
Top founders, that's a really good question. As you probably know, founders have all sorts of different types of personalities, lots of different experiences. I've met a lot of physician founders, a lot of technical engineering founders. The ones that have been successful, I think, are the ones that have done this in the past or have had an experience where they've been able to bring some of these products into the market and really understand the difficulties and the hurdles that are needed to overcome in order to get these products into the market. And so uh, I think the successful founders, a lot of them are ones that have done it before and that they can quickly navigate the issues, have a network that they can, lean onto to be able to overcome some of the difficulties, especially on the regulatory and the clinical side, to get these products onto the market. Other kind of personalities are, they have to be very diligent. They have to be able to prioritize really quickly, understand what's working, what's not working, and pivot and be able to, cut losses, cut staff that may be redundant, or if the product just doesn't seem to be performing, understand, what additional weaknesses the company has, and to try to bring in people relatively quickly, sooner rather than later, to be able to pivot or, address some of these issues within the company, to be able to, again, focus upon, more pressing needs and to get to their milestones. So again, I think priority wise, people that have done some of this before, and again, the next level would be, people that are very diligent and very quick to understand, you get a sense of what's working, what's not working, and to overcome some of the problems, more quickly.
Great. So let's talk about the current market conditions in the fundraising world now for life science. How are they impacting deal flow and valuations?
Yeah, I mean, things have kind of changed, I think, for the better over the past 12 months. With the new administration that has come in, there was a lot of growing pains along, changes in the FDA, changes with the tariffs, trying to sometimes change your supply chain and manufacturing to be able to, overcome some of the, costs. And I'm very proud of our portfolio companies to be able to withstand some of the issues and the cost issues and supply issues, to be able to overcome those and again be on a firm footing. Right now, I think people are a little bit more optimistic about, or they, experienced a lot of the things that have changed, and really understand, how to communicate with the FDA, how to communicate with CMS, and how to prepare, especially on the clinical trial side, how to prepare it and the trials, and to try to really get an understanding what the FDA really wants as their endpoints, and which saves a lot of time, effort, and money, to then finding out later on that you didn't design the trial appropriately, or there are, inadequacies that needs to be filled. So again, I think there's a little bit more optimism now. We're also hoping that there's going to be more IPOs and exits. And it sounded like when we were at JP Morgan, we were very optimistic with the announcements from like Medtronic saying they would like to, really open up and expand and really try to be a little bit more aggressive in terms of their acquisition, which again, in the past couple of months, it sounds like they have been trying to do that with, acquisitions like Scientia and like ResMed picking up Noctrix just recently. So again, it feels a lot more optimistic than it was last year. And especially like, the year before where it was really hard to get an exit and the IPO market seemed to have, kind of shut for devices. And so again, we're hoping that more things comes out and more acquisitions occurs because, these are the ways that the ecosystem kind of rejuvenates itself. You get the capital out and you'll be able to, put that capital back into work.
Right. Yeah. It feels like it's on the uptake here. So looking forward to seeing how it progresses the rest of this year. So what's your approach to risk management and portfolio construction? How do you put that together?
It's been a evolving approach, I think, for us. We, when you're early in the fund, you really are very excited about a lot of things and everything seems to be, all great and endless possibilities. But as you get more accustomed to the companies, your fund, you want to really start looking for things that would get an exit. And so that's how we have kind of sort of changed. We were very, very early on, and now we've sort of shifted a little bit, to more mature companies, sort of post 510K or post PMA with some experience in terms of customers, revenue, and experience to really get a sense of what the end patients and physicians really like or don't like about the product. We do some earlier stage companies but have either like a first in human or EFS studies underway with a robust number of clinical data points that gives us confidence that the pivotal trial would work. So that's sort of how we've kind of changed. We still look at very early stuff. Then we may put in a small check size into some of these companies to see how they progress. But again, we'd like to see them get a little bit closer and with enough, human data to suggest that these products are actually going to work and pass the clinical trials. And so again, we're hoping that more will come out, and we're seeing some of those already. But again, but I personally like to see companies at all stages, really early all the way to late, and try to establish a relationship with them and try to help them along because we like creating an ecosystem with all of these companies. We have a relationship with the American Heart Association that we try to bring them into and to try to help them out. There's programs for incubate. The AHA has an incubator itself. They also have the CHTI program to try to help companies gain entrance into the AHA ecosystem where they can establish relationships with key opinion leaders, cardiologists, and they have a network of, of hundreds of hospitals across the nation where they have clinical specialists set up to be able to access some of these technologies or access these hospitals for these technologies and companies that they might not have been. And so again, I like seeing all sorts of different phases of companies, but again, our main focus right now is probably kind of, something with a little bit more clinical data, and then on the other end with a little bit more utilization and commercial traction.
So what are some lessons learned from past investments, both the successes and the challenges?
Good point. The successes, I think I like the successes where it feels like it's sort of almost on autopilot. So I have this one company that we've invested a long time ago. It's actually been really hard to add additional capital into the company because the company's been so well run. It was and the company is basically a pressure stocking that and a sleeve that does pneumatic compression, but without the pneumatics. And right from the get-go, they kept meeting their milestones, meeting their budgets, growing very rapidly now. And it felt like it's basically again on autopilot, no headaches. And the founder had experience from a prior company and just utilized that to do the exact same thing with this company. And that is, I think, a success where every quarter you get an update and it feels like there's very little wrong with the company, and it's run very well, and it's a tight ship, and the company continues to grow. The challenging ones are those that are a little bit slower to react to the market. I think there may be some changes and the company doesn't pivot quickly enough, and they may be 2 to 3 months behind. That it becomes a lot more expensive and a lot more difficult to pivot to, address some of the issues in the market or internally that should have been done. So I think, the founders and leaders need to kind of always take a look at their environment, the market, and with it, and even within the company itself, to continue to assess on a regular basis, what's going right, what's going wrong, do I need to change, modify, add on additional help sooner, again, rather than later. And that's going to save you time and capital to be able to, again, utilize both time and capital later on to focus upon what's, making the company successful.
Great. Well, so how do you source deals and then build conviction in these competitive markets?
We have a nice relationships with a lot of these kind of feeders. Like, for instance, I've known Paul Grant, a MedTech innovator, for quite some time.
Mhm.
They have a wealth of medical devices. I introduced them to the American Heart Association, and so they create a nice ecosystem around there to try to find or find companies and bring in companies that have cardiovascular opportunities. We have relationships with other hospitals, other funds as well. And, I like creating this nice collaborative ecosystem of other funds because some of these technologies and companies are a little too early for them and they might be more of a fit for us, and others that may be a little bit too late stage and we hand them off to other or more generalist funds. And so we like sharing and collaborating in it, and that creates a very nice collegial share of information that allows us to have, I think, a good enough deal flow to be able to, pick and choose the companies that we think are going to be successful.
Great. So what is the role of macro trends such as AI, play in shaping your investment strategy?
Yeah, I mean, I see it all the time, how AI has more recently influenced a lot of the things that we're doing in the hospital. And so I'm trying to find things that would fit as a specific investment. It has been hard to find something that's purely AI that's a good investment because there's nothing really proprietary about AI, and a lot of the fast followers come right on top. And so you see imaging interpretive companies come in very quickly, went into space, and then there'll be 3 to 4 more that you have never heard of come out. So it's been kind of hard in that ways. AI itself, I think, has been very helpful for a lot of our portfolio companies to try to reduce costs, reduce FTEs or the amount of FTEs to be able to do some of these automated tasks like calling, scheduling, and things like that. So there's definitely a cost savings play for AI in our companies, but as a specific software, it's a little difficult to do unless it's married specifically to a device where the IP around the device and the AI enhances it, gives it a little bit more of a protection. And so that's sort of how we've been kind of looking at the AI space. Right now, there's a lot of opportunities in, for instance, atrial fibrillation, EP. There seems to be quite a bit of a competitive dynamic among all the strategics for opportunities in that area because it's growing so quickly. So that area has been pretty hot. But again, we're continue to look at a lot of different opportunities, and I think the success longer term would be to find those that you can kind of protect pretty aggressively down the road.
Good. So what's your advice for new investors entering the venture ecosystem today?
The new investors, it's really hard to know everything about what's going on. So if you're a new investor, find something that you really like and try to be an expert in that niche because There's so many new things. There's so many, and AI provides you with a lot of opportunities in a lot of different areas. But because of that, I think you have to try to be an expert in a specific field and try to be the best one that you can. Otherwise, you're only going to be skimming the top of the knowledge of what is actually needed to be a good investor. So I would say if you really like, for instance, urology, that's a cup of tea, you should go at it, have at it, just know everything in and out about it. If you like surgery, know everything about it, know everything about robotics, workflow, ins and outs, and start from there. And then try to branch out into areas that you like or are adjacent to it to kind of expand upon your expertise.
Great. Well, in the last few minutes that we have here today, what else should we cover that we haven't?
The environment right now, in terms of like the macro environment for what's going on in the med tech space, I think overall it's going to get better. I'm hoping that with the things that we can't control, like the war in Iran and the oil prices comes down, it will bring down costs. The total impact on pricing and materials and things like that will kind of continue to come down so that it makes it easier for both the entrepreneurs, founders, and companies to kind of conserve on capital to be able to extend out their runway and again make it easier for everybody to kind of produce their products and to commercialize and so that we can focus upon the things that really matter here in the US. So again, I think I'm hopeful that that would occur, and if that does occur, I think I feel very optimistic about what's going to happen in the second half this year in terms of med tech. And as everybody gets used to some of the changes in FDA and CMS, to be able to have them really be a tailwind to our entrepreneurs and companies rather than something that's always looked at as a hurdle.
Great. So how best for listeners to get back in touch with you?
They can go to our website, aphelion.com, and if they have a specific deal or an opportunity that they want to share, they can submit it there. You can always email me at john@aphelioncap.com, APHELION.com, and just reach me that way. And I'll be at these conferences. I'm usually at Wilson Sonsini or AHA, TCT, LSI, or JP Morgan, and kind of reach me then. But yeah.
Great. Well, we'll put your contact details in the show notes. I want to thank you for joining us today and hope to have you back for a follow-up soon.
Thank you.
Investor Connect helps investors interested in startup funding. In this podcast series, experienced investors share their experience and advice. You can learn more at investorconnect.org. Paul T. Martin is the director of Investor Connect, which is a 501c3 nonprofit dedicated to the education of investors for early-stage funding. All opinions expressed by Hall and podcast guests are solely their own opinions and do not reflect the opinion of Investor Connect. This podcast is for informational purposes only and should not be relied upon as a basis for investment decisions.